My name is Saurav and I'm the tax accountant, and today I'm going to cover depreciation. So think about that. If you are a small business owner who wants to understand depreciation and how depreciation is presented into financial statements, or if you are a student who wants to know about the depreciation, or you're just an investor who want to understand the financial statement, so this video will help you understand fixed asset and depreciation in general, what I'm trying to say. So basically I'll cover very high level general principles, but these high level principles will give you a simpler form of understanding to this concept called depreciation. So think about depreciation. What happens is the assets, when you're looking at the financial statements, there are many kind of assets, but think about it, just three simple buckets. So bucket number one is your cash asset. Think about it as like cash, right? So anything that can be converted in cash. So it could be shares, it could be term deposits, and it could be cash in hand, any stock, inventory, and things. So think about that as a cash items. Now the fixed assets, anything that's tangible, that you can touch and you can feel, that is a fixed in nature. For example, this thing is a fixed asset. The table is a fixed asset. Camera is a fixed assets. So that you can touch and feel, right? An intangible is anything that you can't touch and feel, intangible, that is like a website or anything like that. So when we talk about depreciation, we're only talking about depreciation with fixed asset. So fixed asset and depreciation go together. Intangible is amortization. Perhaps another topic we need to cover amortization and intangibles and thing, but today we're just covering fixed asset and depreciation. So whenever you look at the depreciation, few things you need to understand. When you look at the financial statement, there will be a rate. What is the rate of depreciation? So what we are trying to say, this is the asset that we bought today. Let's say motor vehicle, we bought today for $50,000. Now this $50,000, the value of that vehicle is going to be over the years, right? Could be 2 years, 4 years, 5 years. So the expense into financial statements should come into number of years. All the expense should not come together in 1 year. So that's why the rate is important. At what rate we are actually depreciating this asset into our financial statement. For example, phone. You buy a phone for $3,000, right? Now certain asset will depreciate faster, other assets may not depreciate faster. So just phone will depreciate faster, right? Now the motor vehicle will depreciate a little bit slower than phone. We understand, so basic common sense. So these things you need to understand what rate that's being depreciated. Now the rate could be two different kind of rates depending on what jurisdiction you are in. Like if you are in USA, it might be different, New Zealand different, Australia different, India different. So they will have different kind of rates there. So that is called a tax rate, and one is an accounting rate. Now don't get confused in these two kind of different rates, but accounting rates are generally used for accounting, like for financial statement purposes, and tax is used for tax deductions. Now why these two different rates? Think about it. Let's say motor vehicle tax rate is 30%, right? So that's a tax rate. And accounting rate, now accounting rate, it's depending on the accounting standards that what we are using. So based on those accounting standards we'll use, but generally accounting rates are slightly lower. Let's say it's 25%. So think about it, which will give you more advantage. 30% deduction on 50,000 will give you more advantage, because your expense on that would be within the first year, your expense would be 15,000, which is 30% of 50,000. So your income will go lower. So because you're getting high expense, so this is the expense, right? So minus. So you will make more money. I mean, you will pay less tax. So for example, if your income is 50,000 and expense is 15, so now 35,000 is your taxable income. You will pay tax on this income, so which means you will pay less tax. But from accounting, if we are using 25% of that, which is 12,500, so within 12,500, so all of a sudden, as you can see, my income has gone up by $2,500. So now this will be 37,500. So to my investors, this number will look good. To bank, this number will look good. Oh, I'm making more money. But from the tax authorities, I'll say I'm making less money, so I'll pay less tax. So that's why two different kind of rates I used. But in a common, simple terms, small businesses generally use the tax rates. They don't get into accounting. Slightly larger businesses, they will use two different kind of rates. So one for the investors, because they want to look good to the investors if they're making money. But from the tax authorities, they want to pay less tax. This is the rates. That's how you understand the rates. Now, third thing, how the presentation works. So when you look at the financial statements, there are two, focus on just the two parts. One is the profit and loss, which is the P&L, and one is a balance sheet, which is BS, just short form. Now in P&L, the depreciation part will go into expense account. So when you see expense account, so depreciation, you will find it there. And in balance sheet, this will be shown into accumulated depreciation. So fixed assets less accumulated depreciation. It will be shown like that. Fixed assets less accumulated depreciation. Now coming back to that example of motor vehicle, if my depreciation on $50,000 is 15,000, so 15,000 will be shown here in my expense account in P&L. And in fixed asset, it will be shown like this. So my fixed asset, which is a motor vehicle, is 50,000 less accumulated depreciation. So each year, how much I have accumulated. So this is being the first year. So first year depreciation is 15. So balance left is 35, which is my closing book value. So this is how the presentation works. We'll try to keep it simple. And the general entry, just for you to understand what has happened in the accounting books. So accounting books, what has happened? We have done the debit to depreciation, by 15,000 if using the same example, and we have done a credit to accumulated depreciation by 15,000. So always remember, debit and credit has to match each other. So 15,000 depreciation expense, this is an expense, so that has gone to, expense has gone to P&L, and this is accumulated depreciation that has gone straight to balance sheet. Okay, that has happened in the background. Just for you to understand, this is how the financial statements will look. You will see balance sheet, assets, like that. So I'm going back to the same example. So if the motor vehicle asset is, let's say 2023, it was 50,000 less accumulated depreciation, 15,000, and the balance is 35, right? So here it will come like 35 here, and again it's gone down by 15. So balance left is, as you can see, 20,000 left. So this is how it will be presented. Now asset register, financial statement has to be accompanied by asset register. So this is how asset register will look. Asset register will have a cost. So the cost we know is 50,000. So there is the cost. And date of purchase, let's say the date of purchase is 1st of April 22, because we're doing 23. And the rate, we know the rate we're doing is 30%. So opening value, so this is for 2024 asset register. So opening value, we know the opening value this year is 35,000, and accumulated, we have accumulated 15 plus 15, 30,000 worth of this, and this year our depreciation is 15,000, and closing will be opening less depreciation, which is 20,000. Now very important, if you are a student or want to understand that, always remember cost less accumulated, so cost less accumulated and opening less depreciation, they both should be equal to this, right? I say again, cost less accumulated and opening less depreciation should always be equal to closing value. So this is how it's presented in financial statements. Disposal, very quickly, if we disposed an asset, we will say disposal. So let's say if the motor vehicle in third year, in the same example, has no value at all and it disposed, it is zero value, so zero, right? So now we know in previous slide what we're talking about, so 20,000 is the net book value and it disposes zero value, so it will be loss on disposal, right? This is welcome, loss on disposal, okay? But if you have sold it instead of disposing it and you got some money out of it, so 20,000 is sold for, it could be sold for low, could be sold for high. If it's sold for, let's say 15,000, so as you can see, 5,000 balance will be your loss on disposal. Now the loss on disposal is not 20 anymore, it's only 5, right? But if you sold the 20 for more, let's say 30,000, so we have recovered 10,000 worth of depreciation which we have already claimed, which is a depreciation recovery income. I can make another video explaining the disposal part because some entries will be required. But anyway, thanks for watching. This is how depreciation is calculated and how depreciation is done. If you like this video and you want to watch more videos like that, please subscribe my channel and I'll help you to understand the accounting principles. Thank you.